Welcome to today's workshop on Guide for Managing the Finances of a Startup. Why are we focusing on finances of a startup? Finance is something that touches all aspects of an organization. A startup, of course, has many worries. They worry about hiring the right people, getting the right product, identifying the right market or customer segment, producing the product for that market, and then after sales service, they have to get everything right. But finance is a component of the management of a startup that touches every aspect of its operations. Let's start. So when do we start managing the finances of a startup? Do we start before, during the operations of the startup? Here I have a list of stages of starting a startup and running it. So do we start managing the finances at the ideation feasibility study stage before anything is set up, where we are finding the right idea, doing market tests or surveys to identify the customers? Or do we look at financing from the business planning perspective and the various other finances, how we're going to get the funds to run it, where is it going to be used? Do we look at the financing first cycle when the first tranche of funds come in to breathe life into the startup? Is it at a time when we invest money in prototyping and producing the product, the equipment, the factory, the subcontractors, the delivery, the logistics, all that? Is it a time when we do hiring, when we look for the leadership, the rank and file, the production team, marketing team, financing the second cycle, when we are ready to launch the product, when marketing expense will shoot up? Is it at a later stage when we have identified our market segments and we're building the channels in order to communicate, educate, and deliver the products to the customers? Or is it at the exit strategy stage where we're looking at merger and acquisition, where we are thinking of selling the business or finding new partners so that we bring ourselves to the next level of operations? So where does the money go? There are three aspects of funding in the company. One is the capital investment funding. So the buildings that you see, the things that are more permanent, the machinery, even the computers, the desks, the furniture, these are the capital investment funding. Huge sums of money, huge capital layout that has to be tracked over the lifetime, the long lifetime of the asset. Then there's the working capital funding, paying the monthly salaries, the operational expenses, the consumables that are used in the production. A product can have tens, hundreds, thousands of components that you get from different suppliers that need to be paid, the logistics of getting the products in and also out. And some of these deliveries can be overseas into networks outside of your country. And beyond and above these two basic funding requirements, there's this cost of capital. The cost of capital is where we look at how much it costs to get that money to fund your working capital or your capital investment. Loans, of course, come with a cost of interest and time value of money, where dollar is worth more today than later on, or maybe more later on than today. It could be the cost of maintaining a long-term loan, and different loans have different levels of costs. Factoring in, of course, the risks that are associated with having a loan, and the possibility that the company is not able to pay for that loan. So what are the sources of funds that a company can get? We know, of course, you can start a business with your personal cash. That's cash on hand. Family cash, your families can get involved in the business. Bank loans, personal loans, whether you borrow the money as a company or it's under your personal name. Overdrafts, which are very short-term loans, higher interest rates, but you get the loans in for 1, 2, 3 months to pay off suppliers, and then you have to repay the loan pretty quickly. You can get your equipment on leasing or hire purchase. Your cars can be bought on hire purchase. You don't own the equipment or you own the equipment, but end of the day, you have to pay for the cost of the equipment over a period of time. Factoring, seed funding, crowdfunding, angel investments, which are the venture capitalists who come in. They give you the funds in return for certain conditions or even part ownership of your company. So each of this has its own costs, has its own benefits, and the startup CEO or leader and the finance team has to weigh the pros and cons, the risks, and decide which is the best way to go. Some of these may not be available to a startup. Some loans, some bigger loans, some structured loans may not be available to it. So you have to know your options and weigh your options. So that's the first, of course, the first consideration in managing the funds. Where to get the funds, the cheapest funds that you can get with the lowest risk to your company, right? Or you have to boost up your company's track record, sales record, in order, or for example, if your intellectual property, so that's considered an asset that you can use to then get a bigger loan if the bank believes that you can be productive and profitable with that asset. So these are the financing decisions that you start with, and you find that at every stage of your growth, these are the same questions that will come back to be decided by management. So what are the important decisions that the management or the finance director, manager has to take care of? Let's look at the right side, the important decisions. You look at the financial structure of the business. Do you want to go heavy on debt, running your company on debt, servicing your interest at regular periods, or full equity? That means you fully own the company, in which you have full control of the company. There is no right and wrong. Having full equity, you have full control, but you're also exposed to larger risks. Having debt, you are exposed to interest rates, sometimes exchange rates fluctuations, but at the same time, you might be able to extend how far you can grow, how big you can be, because you have additional debt on top of your equity to help you grow. Capital expenditure and capital rationing, how much you want to spend on your factory. Of course, we want to get the best deal. If you want to buy a shop space, we might buy second-hand equipment. We might have 5 projects we want to build, and then you just maybe focus on 2 first and then schedule the other 3 later on when you hit a certain profit level. Working capital, how big you want your team to be, how much control you have over your consumables, the operational expenses, transport, petty cash, which then leads to your control of cash flow. Do you know at any moment where your cash is going to? How is it used? And is it used in a productive manner that adds value to your operations? Sometimes this value can be intangible. It can be used to improve customer relations, advertising, to promote the company, to build up the brand. So that is the cash flow. And of course, liquidity, how much cash you have at any time. Most companies, their cash is tied up in terms of buildings, cars, machinery, the goods they have produced in the warehouse, the raw materials they use to produce the goods are then stacked up in another warehouse or in a corner, and those goods that are used to produce the product, sometimes you can negotiate and ask the suppliers to supply what they call just in time, so that you don't need to have big space to store maybe 6 months of raw materials. You can store 1 month, but the supplier can replenish at a very short notice. Interest rates and taxes, you need to know the tax laws very well. Sometimes there are tax holidays that companies are given for the first 3 years of their lives. Interest rates, different banks, the negotiation you do with the loan officers, these are the ones that can affect the cost of the capital. Loans can be short, medium, long term. So do you want to use a short-term loan, which is usually more costly, a long-term loan, in which case you need a relationship with the bank? So different dynamics for this based on your relationship with your bank. More complex, you can have structured finance, hedging, where you put aside some money or you use certain instruments, you take on certain loans or you do certain investments in order to hedge against maybe inflation or foreign exchange fluctuations, securities, stock market, invest in bonds, put a portion of your money there with the hope that it will increase. So money in the bank can be called reserve. We sometimes call it war chest because it's there for you to overcome any crisis like the COVID-19 pandemic. If you have a strong war chest, or you have a competitor that you are competing intensely with, a new entrant into the market, you have a war chest so that you can sustain the publicity, the advertising, the promotion, the marketing, the operations over crisis, over competition. And of course, your entry, growth, and exit strategies affect a lot on how you want to finance the company. Do you want to grow fast? It's like you're driving a car. Do you want to accelerate fast? You want to run at a steady pace? It's a windy road. Do you want to risk it and speed ahead so that you can overtake your competitors? Or you grow at a steady pace. Amazon, for example, took almost a decade to turn a profit. But now they are doing very well. So, what are the 3 key considerations when you make these important decisions? One is the matching period. If you need an asset, like equipment, let's say a car, for say 5 years, and you take a loan for 5 years. If you take it for 10 years, you'll be carrying the liability over a longer period than the useful life of the asset. There's no right and wrong, but we do try to do matching. If you think you're getting a certain revenue in, that revenue will be used to pay off the loans for that period or even longer term loans. But the matching period, knowing how much you're getting every month and also matching it to make sure that you're able to repay your loan at any time in the duration of a loan and not default. Matching amounts. You need a certain amount to buy this car. Do you borrow exactly amount, slightly more to cover some of the maintenance or slightly less so that you carry less debt burden and you rely on your equity more, and of course your credit worthiness. When the bank looks at you, angel investors look at you, how much confidence they have in you, how much confidence do they have in your management team, your business plan, how realistic they think it is. They'll do their own research, they will do their own due diligence, and they'll decide on your credit worthiness, what is your track record of repayment, whether you have defaulted before. So each financial instrument differs in timing, the principal repayment and interest terms and credit criteria, which are all basically negotiable with the bank. Excuse me. So let's start the cafe. If your business is, say, a Starbucks, coffee shop, you have to look at your capital commitments. You have the shop, the tables, the equipment to make the coffee, the cups, the crockery, and all that. You need promotion activity. It could be as simple as a signboard outside. You could put it on the radio, on the TV. You can do social media advertising. The deposits you need to put in when you buy from your suppliers who are new to you and you're new to them, so they may give you a higher price. The working capital, how many staff you want to hire, what is the efficiency of your production, the wastage of the coffee, say coffee powder for every cup you make, the water, the utilities. So that part is about efficiency, getting the right people, the right size of the team, the right amount of coffee bags that you need to keep for a day, a week. If you're selling bagels, how many bagels do you keep every day? And the wastage that you're getting, you keep too much, or the unhappy customers you have if you keep too few and you can't serve them. And of course, there are the professional services that you have to pay for, the lawyers, the accountants, the company secretaries. You might even have a tax advisor that you pay for, right? So, common wisdom, when we make all these decisions, we talk about turnover is vanity. So we can boast about, oh, we're raking in 100 million, 1 million, 10,000, 100,000 per month, per year. But honestly, at the top line, it doesn't mean much, because when you start taking away the cost of operations, the cost of capital, and all the various costs that you have, you are left with maybe a big profit, maybe a small profit. So it's nothing to boast about. And the quality of the turnover, is it consistent? Do you see it happening for the next 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 years? It could be up and down, like mood swings, you know. When you're happy, you feel strong. When you're sad, you feel weak. So is it consistent? Is it constant, the quality of the turnover? Profit is sanity. Keeping an eye on your profit to make sure that you get something out of it, especially for entrepreneurs. You get something out of it that you can survive and be happy with, is a sanity check. Being a starving CEO with a company for months on end, where your family is affected, it's not entirely sustainable. It's doable, but it's not sustainable. So profit is a sanity check, but cash is king. So the first priority is to look at your war chest, how much cash you have that you can spend immediately to take up an opportunity, to fix an equipment that's broken, and therefore your production carries on. You don't lose a day of operations. You don't default on any loans. So the reliability is the cash. Anything else besides cash, assets like buildings, cars, and all that, it takes time to put it on the market and sell it. The amount that you get back is uncertain unless you have a contract to sell it off at a certain price at a certain time. But then again, the condition of the asset counts. So cash is the most reliable asset you can have in order to react very quickly. And sometimes time is of the essence, because loans, rental, utility bills, as we all know, your mobile phone bills, they're all predicated on timing, they're all scheduled. And if you miss it, the penalties start to add up. With all this universe of decisions that you've made, we've given you the background. Then you look at your company, there are basically 3 reports you can use to answer the questions that we just mentioned, and to help you make the decisions. So the numbers, they count, not just the top line, the turnover as you mentioned, but also what comes underneath that. So the first report we look at is the profit and loss statement. There's a sample here, shown here. The profit and loss shows the sales, the money that comes in from sales. If you provide services, how much it comes in, other income, maybe you provide transportation services, and that's your total income. That's the money that comes into the company, it's turnover. It's a feel-good section of the profit and loss statement. Then comes the reality check, the expenses. I'll just pick a few, like advertising costs on social media, consumables from stationery to things that you use in your operations, bank charges, right, administrative charges. Then comes the cost of goods sold. Cost of goods sold includes the consumables you use in the production, storage of it. So when the product, 1 unit of your product is produced, how much of it is cost and how much of it is profit. Right? Some products are 30% profit, some products are more than 100% profit. Some products you get, say, 10%, 5% profit on every item. So again, there's volume sales and then there's value sales, basically. And then after you take away the expenses from the income, you have the profit. Then from the profit, you pay your taxes and the interests to the bank on all your loans. You get your net profit, right? So after your salespeople have worked very hard, your operational staff, your service staff have worked very hard, they have made themselves very efficient, they have squeezed out the wastage, they have been very vigilant, they have redesigned the production system so that the flow is like McDonald's, maximized operational efficiency, everything is within the reach of the server, so your cost is minimized, right? Your overheads is also minimized. You found a location where they give you a good rental over 5 years, right? And you have trimmed your management team to a very thin layer. You get your net profit, and that is a measure of the performance of your team. Just like a runner running around the 400-meter dash or long distance running or marathon, is how far you can get on what you have. Right? So what you have is limited, and if you can get much further, your performance is higher. Hopefully you outperform your competitors. So this is a floor plan of the cafe. What do you think are the P&L items that you see, and which are the ones that you think are the most important, right? Profit and loss. So the layout, if it is optimized, your serving time will be maximized. The number of tables that a server can monitor for customers and help turn over the table will be maximized. So you don't need such a huge staff, right? You can have a very efficient small team managing the whole cafe. The materials is made of easy to clean. The fixtures will impact the utilities, your utility bill. Whether you're buying for a central kitchen or you're doing cooking on site, all this will affect your overhead and your expenses. So you start to see the elements of a P&L in your shop right now, and what you can do to control the performance of your team, to balance the performance of your team. Right? You lower the operating costs, right? You increase the sales. Advertising might go up, but sales might go up 5 times. Right? You hire a good staff that costs maybe 1.5 times more, but the person brings in 3 times the income. So it's always a balance. So this is an example of a profit and loss statement with all the numbers inside, the sales, all the items that they make money from, and this could be your P&L. You run a small coffee shop or small food retail. So under cost of goods sold, here is very simply the cost of what you bought it at and how much you sold it at, right? Then the labor cost that you have inside. So these are the major components. The inventory is a major cost. The labor cost, the staff cost is a major cost. And of course, utilities and rental is also a major cost. Okay. The next report you look at is, of course, the balance sheet. Performance is about how your team is doing as it runs round or as it runs on the marathon. Assets is basically what the money you brought into the company, what has it gained in terms of tangible, mostly tangible assets. Basically, where did the money go, right? And this is important because it talks about the health of your company. If you start with, say, $100 and you spend 80 on equipment, cars, chairs, furnishings, and all that, so you have $20 left in cash. So would you consider that a healthy company? Right? It's subjective. Having more cash will mean that technically you are in a more secure position. You can repay any debt at any point. So if you run a company and you start saving the money instead of keep spending the money, or the investors or shareholders or management start taking the money out for their own personal use or for vanity projects, then your cash component will be low. The company's health would be, of course, less. Right? It's like how much breath you have when you run. Right? Good runners have very good breath. So they can run longer, they are more so-called healthier. Right? So let's look at the balance sheet now. You are looking at the assets, the current assets, the long-term investments and funds. So all the buildings you have, the property, plant, equipment that you have that you can sell, right? So these are basically a value that's taken at a certain time. You bought this plot of land at this amount of money, so we put it into the books. It can be revised over time. There are some intangible assets like branding, customer relationships and all that, which you might want to quantify, because sometimes, for example, a brand like Facebook or Amazon, when you buy it, you actually have to pay for the brand and of course their network of customers or loyal customers, because they're worth money, right? So you have the assets, and how did you get those assets? Well, you took long-term loans, you took short-term loans, you had owner's equity, you had retained earnings from previous years, right? So the liability is not about cash, right? Except maybe retained earnings is there, all right? The liabilities basically say, how did you get the money to pay for the assets, right? So your liabilities could be entirely in terms of loan, could be your own equity that has been used up to buy the assets, and what remains is basically cash on hand. Okay, so the total stockholders or shareholders equity, and then you have the total liability, and then you have the total assets. So basically your assets, once again, is equal to where you got your money, which is two parts. Your liabilities because you have to pay back, you're liable to pay back, you're responsible to pay back, which are your loans. And then you have the equity, which is the money that you actually own. Right. So if we return to our coffee shop, what are the balance sheet items that you will focus on now? Knowing that you are balancing between the assets you paid for and the money that you managed to get into your business. So now you start to see the tables, chairs, if you bought the building, then it is an asset, right? So that's where all the money went, basically. Okay. And over time, your asset will, of course, either appreciate or depreciate. So if you make the right decisions, your investment in the asset into a building and all that can go up. So it's better than keeping cash. So again, everything is dynamic. It depends on your objective, what you want to achieve, and the level of security and health that you want. So for companies that held a lot of cash, they would go through crisis or competition much better than companies that ran on a very thin margin with a very thin savings or reserves. And the third report that we want to look at is the cash flow statement. And here's an example. So between the profit and loss and the balance sheet, we don't actually see the flow of money. Right? We don't get a snapshot. Oh, I'm spending $1 today. Can I spend $10 tomorrow? Can I have $100 3 months from now to spend on something else? So if you don't have that long-term view of where and when the money is coming in and where and when the money is going out, then you're going to have a bit of a time problem, because P&Ls can be produced monthly, but usually they're audited on a yearly basis. Balance sheet again, monthly or yearly basis. So they're snapshots, right? And if you look at the figures, they're all quite high level figures. You don't actually see when and where, you know. So if you have 5 companies in 5 countries, and the cost goes up, you don't really know where the cost is. It could be in a different location, and you need to drill down. That's one. And also you need to monitor your cash, because you need that to again repay your loans, pay salaries. So you cannot have a shortfall at any time. You cannot pay salaries late. You cannot pay suppliers beyond the time that they give you. Sometimes they're very generous. You go beyond that, you lose the relationship with the bank or the supplier. Banks can be seen as suppliers of cash. Right? So here you can see in this report, it's very clear where the money went. Went into investing in the property, went into financing a cash flow, went into depreciation, amortization. Some of these are accounting terms, right? So this will add to your decision. Profit and loss decides on how performance of your team, how you can tweak the performance of your team. Balance sheet tells you where your money went, where your assets are, so you can keep track of it. Sometimes you might want to say, I think I'll sell this car and buy a truck, right? So That one gives you a clear picture of where your assets is, so that you can decide what's the next move you want to make. But the cash flow is your daily monitor that tells you where the money is going towards. Is there a sinkhole somewhere where the money is just pouring in? Is there an area that you have been neglecting and not captured anywhere, where the cash is flowing? So it's important. Remember, cash is king. So if cash is king, you're going to know where your king is going. And that's where the cash flow statement comes in. Finally, we end. All right. So I will end today's workshop on some tips on managing your cash flow, since it's so important. Bill your customers promptly. Don't hesitate. Send them the bill early. Give them whatever credit terms or time you want them to repay. But bill them. Start the clock ticking as soon as possible. Make sure your invoice billing is accurate. Don't rebill. It wastes time, wastes your staff's time. And sometimes it resets the clock for collection. Use different pricing strategies. Don't always go low. Sometimes you go for a decent or good margin. So because if you keep going low, you are basically reducing your cash flow all the time. Use different costing strategies. By this I mean, find different suppliers to reduce your costs, lower your efficiency, lower your inefficiencies, lower your wastage. Maybe buying in bulk, yes, and how you calculate the cost, how you manage your inventory. Set appropriate due dates for when loans should come in. Right? Don't play with the dates when you have to pay off a loan, because of the penalties will add up. Follow up on your debtors. Call them up and say, hey, can we work out something? All right. Use free credit from your suppliers. Negotiate very hard with your suppliers to get the longest time to repay them, because you see, working capital is monthly, right? So if you have to repay your supplier over 3 months, you can roll that money for 3 months before paying the supplier, right? So you get more out of your money. Money is fuel. Monitor your bank accounts and statements. Look at your P&L, balance sheet, and cash flow statements diligently. Set up KPIs, key performance indicators. Our margins must be 30%. Our margin must not be below 10%. And stick to the KPIs. Right? Set some standards for performance, for the use of funds, for cash flow. Right? Set criteria that only certain people can approve certain cash flows or capital expenditure, or even buying consumables. Set up controls. So analyze your statements and keep an eye on your bank account. Right? Some people find it uncomfortable to look at a bank account because it doesn't look good all the time, but no. Cash is king. Keep your stakeholders, financiers up to date. Talk to your banks, tell them what's happening, send them regular updates. Your stakeholders, your customers, keep them updated with your company, because at some point you might need to negotiate the price, you might need to negotiate the interest rate, so you already have that relationship with them. It's not only transactional, but they become vested with your interests as well. And keep your tax records up to date. Never fall afoul of the tax authorities. There are a few things that are certain in life, and tax is one of them. So I'd like to thank you for your attention. I'd like to thank MCM for organizing this opportunity for me to meet with you through this medium. and we'll be glad to answer any questions that you have. I think MCM will be arranging for that. Thank you. Thank you.